We begin the second half of our corporate finance course this week, week number 5, July 3 through July 9th. Hello, everybody. This is Professor Hasse again, speaking live and in color from Claremont, California. We conclude our second week of capital budgeting risk analysis this week with you submitting case number 2 this Sunday, July 9th. We're going to wrap up our discussion of capital budget analysis and then head into week 6 where we look at financial statement analysis. But this capital budgeting risk analysis is a key in corporate finance. Remember, the goal of finance in any entity, not-for-profit or profit, is to maximize the company's value, make the company have a greater wealth. What greater wealth for the investors, greater wealth for the employees, for the company, for its against its competitors, to maximize the value. Well, to do that, you need to invest in assets at the cheapest cost and the greatest return. And before you can make that decision or that strategic decision, which asset is the best? And that's what this capital budgeting risk analysis is. Before you spend a nickel, you can determine whether an investment is prudent or not in your strategic thinking. And that's what's so key about this in corporate finance. So that's why we do case number 2, and that's why we wrap up our study this week. Today's date is Wednesday, July 5. I'm having an update video on Friday, which will be introducing our case assessment paper and we have our student hours this Thursday, July 6th from 6 to 8 p.m. If you have any questions about the case number 2 or any other topics as we begin the second half of our corporate finance course. As we take a look at week 5 on our Blackboard, we again, as always, we're looking at case number 2. The interesting thing about this case is I provide you the template or the spreadsheet to do your work on, and that's what this case number 2 template is. So again, you are to download that spreadsheet, do your work on it, very similar to the problem we began last week and the one we're finishing up today, to do a risk analysis of a company's specific strategic project. And that's case number 2. The information is in week number 5 this week. Here is our lecture video file folder. Here's the file I'll be working on today. Picking up from our original discussion of week 4, and there's the solutions to that file to help you. This is, again, very similar to what you're doing in case number 2. Then on Friday, I'll be posting our course assessment paper, which is very similar to case number 2. You're doing basically the exact same analysis. Naturally, the numbers will be different, and you'll be calculating the numbers and looking at the variables. But also, in addition to that, you'll be doing a paper explaining your work, which is a little bit different than case number 2, where all you have to do is give me a yes or a no as whether this project is viable. But in the course assessment case, which is due Sunday, July 30th, which I'll introduce this weekend, there you have to do a paper interpreting the results of your spreadsheet analysis. And here's that spreadsheet that we began last week in week 4, defining the capital budgeting process. It's a series of steps to review the investment, prepare the cash flow, prepare the return analysis, and then do a risk review of the work. We began by determining the cost of capital for the project, which was 9.68%, which is taking the capital structure, the current capital structure of a company, determining the after-tax cost of debt and the cost of equity, or the required rate of return on equity in relationship to the markets. And in this case, 9.68%. Then what we did last week is we took the variables of a $1 million investment and determined the net project cash flow, which was about $2.6 million. And there we determined that the project, what was its return in dollars, net present value, in percent, internal rate of return, in profitability, in a ratio and in payback in years. And we did this analysis last week. Now we're going to take that analysis and do a risk analysis, a scenario analysis, and a sensitivity analysis, taking a look at changes in output volume and its relative probability, and changes in key variables, in this case, selling price per unit, variable cost per unit, and the weighted average cost of capital. This is our example, fairly similar to case number 2. The only difference really in case number 2 is the third sensitivity variable is fixed cost, not WACC. You get that base analysis done, you go to part 2. And this is the third tab in the spreadsheet template that's given to you for case number 2. I ask you to do a scenario and sensitivity analysis. And that's the subject of our lecture tonight with that sample that we began last week. All right. We'll take a look at that in just a minute. Then the final question of this case, and you can write it on the spreadsheet at the end of your analysis, how does the risk analysis affect net present value? Please show the calculation. So you don't really have to write anything. You're showing me the calculations provided in that template of what the scenario analysis is at different volumes of unit sales, and the sensitivity analysis, specific changes in 3 different variables of the case: selling price per unit, variable cost per unit, and fixed cost. How do those changes affect the net present value? And that's the basis of part 2, and you'll show those in your table that I have provided for you. So that's case number 2, a good spreadsheet analysis of an investment by a company. Is the return doable? All right. Again, here is that template file that I provide you in case number 2. You are to download this file and do all your work and calculations on this spreadsheet. So again, based on the information I gave you, calculate the WACC. Based on the information and the variables given to you, calculate NPV, IRR, profitability index, and payback, and give a yes or no to the analysis. And based on the information I give you, determine the sensitivity NPV and determine the NPV at the variety of different, the scenario NPV, and then the entire variety of sensitivity NPVs. And I'm going to show you that in just a minute. And once you do this, the graph will be constructed on its own. You don't have to do anything about that. It'll create itself based on the data here. So that's the case template that you need to do your work on for this week. So now let's pick up on that work file that we started in week 4 that defined the capital budgeted process, that defined how to calculate the weighted average cost of capital. In this case, it was 9.78%. Notice that format is exactly the same in the case number 2, but the numbers are a little bit different. You are to adapt to that. Remember, you also did this calculation for your company in your case number 1 paper. So you fill that in. Then you go to the base analysis, and we finished this up last week at our weekend video, is how you complete the base case analysis to determine NPV, IRR, profitability, and payback. Now, if I was interpreting this information, I would definitely give this a yes. I would give this definitely a yes, because why? Because the net present value is almost $385,000 profit over the 10-year life. The internal rate of return is 17.03%, almost double the cost of the capital. The profitability index ratio is greater than 1, and the payback is in less than half the amount of depreciable life of the asset. Pretty positive. So I would give this a yes if I was interpreting this. I'm looking for you to do the same thing in case number 2. Now remember though, case number 2 is a 7-year life, not 10. That spreadsheet is given to you. Case number 2 has different variables. So you have to make sure you get those variables, insert them in that template, and then do the calculations, including inflation. Now, the inflation will be different from what you're seeing here. So that's part of your assessment, is for you to adapt and change that spreadsheet and then make the interpretation of the analysis. The second and the last part of this case is to do a risk analysis. And that's what we're going to work on here. Remember, the risk analysis is from the textbook, chapter 11. And it's, if in case of any of you, pages 469 to 473, 465 to 473, if you want to refer that to your book. But this should be enough of referral and practice here in doing this. It's a little bit different. The risk analysis is taking the base case, which in this case is 25,000 units produced, taking the NPV. Now, we've already done that calculation here. Remember, 25,000 units produced. What's our NPV? $384,719. So we take that 384, insert it in our spreadsheet, and automatically it takes 50% of that, and there's our probability and NPV. Now, here's what scenario analysis is all about. It determines, all right, how is it my profits going to change if I sell more or sell yet less during the depreciable life? And then you record it or interpret it as the likelihood that is happening. Now, many of you have taken statistics at some time or another, and this has to do a lot with the risk managers of a corporation or even the public accountants. They will determine the likelihood or the probability or the risk involved in of you achieving these different types of scenarios. It's a 50% chance we're going to sell our base case 25,000. There's a 25% chance we'll sell 35,000. There's a 25% chance we'll sell 12,500. Incorporate all those and determine a weighted average of that probability. So again, now for 35,000, we just go back to our spreadsheet and just insert right here, instead of 25,000, 35,000. And automatically everything changes because I set the spreadsheet up accordingly. And this is one of the key things that you have to do. Set it up so automatically all you do is change one set of numbers and everything changes. That's why it might be a good idea when you set up your template. For some students, they'll maybe want to do this individually and set it up. Some might just copy the spreadsheet and insert it in the template for the case. But remember, when you do that, you're going to have to make sure you change all the variables in these certain columns. But that's one way of doing it. So notice, $35,000 unit sales is going to produce an NPV of $948,836. So now I put that $948,836 right here and weight it by 25% probability, and there's that NPV probability. I go back to the base case and now change that to the sensitivity number of 12,500 units sold. And automatically it changes. And notice now at selling 12,500 units, we're going to lose $320,426. We'll put that here. Minus 320,426. And now we have a minus weighted there. So what now the sensitivity analysis takes us, and it weights the NPVs at these different levels of sales, and it weights them by the probability of them occurring, and the total is still a positive number. Pretty good number, by the way, 349,462. So taking all these scenarios and averaging them out, we're still making a nice hefty profit. But the thing to beware on this, and this is what financial analysts do, is we now know if we get close to 12,500 units in the future of this project, if all of a sudden the numbers start going south, we know that we're in danger of losing money. And this is not the break-even point of this project, but pretty close. At 12,500 units, we're losing big time money. So it tells the manager of this investment, yes, we'll probably approve the project. It looks profitable, even taking into account the scenarios. But we have to make sure that if we see our sales dropping dramatically, maybe because of a pandemic, a change in the market, our customers don't like us anymore, whatever, we need to be aware of that as we get closer to maybe 15,000 units, 17,000 units, we're going to start losing money and we have to be careful. And that's an important management analytical number. So there's the sensitivity analysis. Just takes taking the base case and adjusting the, I put it in green here, the units for each of those scenarios. Now I'm going to go back to the original base case. And there we go. We're back to normal 384,719. That's what we calculated last week. So now we're set up used to do this sensitivity analysis. The sensitivity analysis is to just change these individual variables one at a time, not all at once. We change the selling price by negative 15%, what's the NPV? By negative 10%, what's the NPV? And so on. Saying what is the variables of when we start losing money if certain key variables change by a certain percent. That's what the sensitivity. How sensitive are the variables to losing money? Now, naturally, selling price probably is going to be our most sensitive variable because everything revolves around the revenue. So if all of a sudden, in order to sell 25,000 units, we have to reduce our selling price by 15% to sell 25,000 units in our base case, what is that going to do to our profits or NPV? Well, let's take a look at that. We go back to the base case, and now we go to our selling price per unit right here, $20, and we now reduce that by times 0.85. Right? 1 minus 15% is 0.85. So we're now going to take 85% times the $20. And because I have this already set up in our format, watch what happens. Boom. We now go from 384,000 with a 15% reduction in our selling price per unit. Our NPV now goes to $32,675. So we put that here. 32,675. All right, now watch what happens as we start putting this data. This chart will grow. So now let's go back to the base case and reduce our selling price by 10%. So it'll be $20 times 0.9, right? 10% reduction. 150,023 is our NPV. Go back here. 150,023, and now you begin to see the chart taking place as it's taking these values. A 5% reduction in the selling price, $20 times 0.95. We now have 267,371. 267,371. With no change in our selling price, we have our original base case of 384,719. Okay, now notice, I know I'm doing this correctly because my line is staying straight. If this line has bumps in it or starts curving, it means you did something wrong in this calculation. And I'll show you that. Now in the second half of this, now we're going to increase the selling price by 5%. Let's say we have a product like Apple Computer iPhone that if we sell 25,000 units, we can get away with even selling it at a higher price because there's such a demand for our product. So let's increase the $20 back in our base case by taking $20 times a 5% increase, 1.05. And now we're making even more money, 502,067. Notice when I change this, because I set this spreadsheet up properly, my weighted average cost of capital changes, everything changes accordingly. Pretty nifty. That's what spreadsheets are so great to have in finance. So now 582,067, 502,067. And there we go. Now a 10% increase in our selling price, 1.10. 619,416. Now let's say 619,416. Let's say I do a typo and I put in 519,614. Because let's say I make a mistake in typing it in. Look what happens to the line. Oh, I know I made a mistake. What did I do? It's not exactly straight. It's not staying consistent with the 555 delta of each one of those lines. So I know I did something wrong. I got to go back to my analysis and say, oh yeah, 619, 416. All right, 619, 416. And I put that in and it straightens out. Pretty nifty, huh? And then finally, 15% return or increase in our selling price. Boy, this is a real good company. They can increase their price 15% and still sell those 25,000 units. So that's times 1.15. And we're making 736, 764. 736, 764. And there we're done. So now we've completed the sensitivity analysis saying that if we change our selling price by lowering it or increasing it to meet the demand in the market of 25,000 units, the spread from below bottom to top is roughly $704,000. That's the delta or the range of this analysis. And that range or delta is indicated in the degree of this line. The higher the range, the more steeper the slope of the line. And that's what we're doing here. Now, let's do variable cost per unit. But before we do that, we got to remember, we got to go back to the base case and make everything where it was in the beginning, $20 a unit. All right, we're back at 384, 719. So now what's the sensitivity analysis in this? Well, our variable cost rate in this problem is $8 a unit. So now we're going to change $8 by these variety of deviations in the sensitivity change of that cost per unit. So $8 back to the base case. We now will put in $8 times 0.85, a 15% reduction. So we're going to start making more money if we reduce our costs. And whoops, there we go. And I purposely did this. Now remember, we just took 85% of $8 and got $6.80. But what happened? All right, we need what happened to our variable cost rate. All right, B8 is the number of units times 8. So our number didn't change. So I set up the spreadsheet incorrect here. I did not include the cell that the variable cost is in. I just put in $8. So now I got to go back to this formula and put in the cell that $6.80 is, which is B11. Input that, and everything now changes because now I've matched the cell with the change or delta in the cost per unit. So that's sometimes a mistake that some of us use. I already set that up in this problem for revenue, but I did not do it for variable costs. And now when I did that, the rest of the spreadsheet takes over. And so with a 15% reduction in variable cost per unit to $6.80, I'm now making $525 to $20. $525 to $20. Notice I put that here. These are all done. Don't worry about them. Now I go back, $8 times 0.9, a 10% reduction in cost. Now that I have my spreadsheet all formalized, 478, 386. My NPD now goes to 478, 386. And now, as you can see, my line is beginning. Notice revenue gut line goes left to right. Expense line goes right to left. I say that right? Left to right? Whatever. Okay, whatever. It goes the opposite direction. 5% reduction in variable cost, 0.95, 431,553. My line is staying straight. Now we just type in 384,719 with no change. It goes back to our original base case. All right, cool. And then now we change, now we begin to increase the cost of variable costs by 5%. So $8 times 1.05. Now we're going to make probably less money. There we go. 337,886. Technology, isn't it wonderful? Increase our cost by 10%, 1.10. Be a good idea if you practice this on your own with this spreadsheet from Blackboard. 291,052. Okay. And then a 15% increase in cost, 1.15, 244,219. And there we go. And notice, you know, you also did this right because the line is straight, but also where they intersect right here is 384,719, which is your NPV of your original base case. So you know you did this right because they intersect right at that line. Notice the range is a lot lower than the selling price per unit, and notice the line is a lot flatter. That tells you that selling price is a lot more sensitive to change than your variable costs, and that makes sense because it's a higher amount. Okay, now let's go back to the base case and go back to normal. Go back to just the straight $8. And now everything's back to normal. So now we're going to do the third variable in this case. Remember, our fixed costs are $50,000. There they are right there. So now we're going to adjust the fixed cost by these deviations. Notice we don't touch any of these anymore. How does the fixed cost deltas affect NPV? So let's go back and go to fixed costs equals 50,000 times 0.85, 42,005. But remember, oh, this didn't change because I just typed in the 50,000. So I'm going to have to adjust this cell to equal this cell here. So it'll automatically change every time when I make that adjusting delta. So a 15% reduction in the $50,000 fixed cost means a reduction of $7,500 in my fixed cost. That gives me 418,534 NPV. Okay. The cool thing about spreadsheets in this analysis is it does all our discounted cash flow. Once we do this, everything is all set up once we do these adjustments. So let's reduce our selling price of fixed cost by 10% to 0.9, 50,000 times 0.9. We get 45,407,262. 407,262. And there's the line again. And now we go to 5% reduction in fixed cost, 0.95, 395,991. Type in the 384,719. And there we go. Notice this line is even flatter. Let's see how this ends up. Now we increase the fixed cost by 5%. 373,448. Increase it by 10%. 362,176. The line is staying straight. And finally, a 15% increase in fixed cost, 1.15, 350, 905. The line stays nice and straight. And notice here, the range is only 67,629 top to bottom. So definitely the fixed cost is the least sensitive variable. So a couple things to note after we get done with this analysis. And I'll go to that. First of all, let's go back to my spreadsheet and make sure everything was back where it was before, just so when I post this to Mr. Hassey, he's cool with everything. There you go. Now, what does the sensitivity analysis? Well, it tells us that if we decide to change the selling price in any way to make sure we sell those 25,000 units, if we have to lower the selling price, we're dramatically going to cut into our profits. If we have the luxury of increasing our selling price, like Apple Computer, we can make even more money. But it tells us that the sensitivity variable is selling price because it's steeper slope. If we increase or decrease our cost of manufacturing or variable costs, it's still a pretty good change. But notice it doesn't really get to be too ugly. The same thing with fixed cost. The range is not that high. And we can show this range or sensitivity by the slope of those lines. And it's a nice thing to present to investors or to managers about how this does. In the real world, companies, through the software of SAP and through the software of Oracle, can produce these automatically by downloading the accounting information of the company. And many sensitivity analysis are made for every expense of that particular project. So the managers can see the sensitivity issues of their product. Pretty cool. Now, pretty cool if you're a financial person. If you're not a financial person, this is really exciting. But for our class, this is important because number one, you're doing this in case number 2, and you're doing this also in the course assessment paper, and we'll see that on Friday. So I'm now going to save this and post it to week number 5 in our in-class review file folder. So you now have this downloaded version of the entire process of capital budgeting, determining the discount rate or the cost of capital, doing the base analysis and the return analysis, and then finally doing the risk analysis, changing the levels of unit sales based on a probability and changing certain key sensitivity variables by a deviation of certain percentage ranges. Now, in some companies, they start at minus 30%. In this example, it's 15%. So that's our analysis for this week number 5. You are to incorporate this analysis in your case number 2, and you'll use it again in another couple weeks with the course assessment paper. Thanks, everybody. I'll see you all on Friday or before then in our student hours, but I'll see you all on Friday with an update video going over this course assessment paper and dealing with any final questions you may have on this capital budget process. A lot of spreadsheet work this week. It's a nature of the beast in financial management. Have a great week, everybody. Adios.